Hey guys, welcome. It is 2021, or 22. Wow, happy New Year. Thank you guys for being here. It is live at 5. My name is Jeb Smith. If you're new to the channel, new to the show, guest Josh Lewis. He is a mortgage professional here in Southern California, along with myself. And we're here to answer any real estate and mortgage related questions you have about the housing market, whether you're a first time home buyer, second home buyer, seasoned investor, doesn't matter. Put your questions in the comments below. We'll do our best to get to them. Josh, welcome to the show. Happy New Year.
Well, I don't know about happy. Depending on what's going on
Oh
in
boy.
your world, tells you whether you're going to be happy about it or not.
Don't you make that choice yourself,
Well, I
regardless of
did.
what's going on around you?
I got to get in my pool last night for the first time, our new pool at 52 degrees for the first time. So that was an invigorating New Year's experience for us.
Some people don't have pools, Josh. Be thankful.
I'm
You know?
thrilled. I'm thrilled. I'm going to get in it at 52 degrees every day just to remind myself of the joy.
Yeah, I bet you are. So guys, we've had some news come out, right? So we ended the last show prior to the new year, if you will. Inventory here locally was at an all-time low. I think here in Orange County, we closed the year out somewhere around 900 active listings on the market, which is really, really low. As of today, about a week later since I last looked, we have just over 1,021, 1,030, somewhere in that active listings on the market. This time last year, we had 2,600 active listings on the market. So do the math. We're 40% or so of where we were a year ago. And here in Huntington Beach, where I'm located, only 74 active listings. So a lot less property on the market at the moment, which is typical for this time of year, right? We don't expect inventory to pick up quite yet. We are expecting, more and more property to continue to come to the market over the next couple of weeks leading into that spring market. But we'll talk more about that because I'm sure we're going to have some questions. But today the Fed came out. Or actually the minutes were released rather from December. And it spooked the market a little bit. The stock market, right? Tech got hammered across the board. And people are a little worrisome, if you will, Josh, about potentially higher interest rates sooner rather than later. So let's talk about this a minute. What are your thoughts on this? I know you follow some experts in this field, and they have some some thoughts, and let's hear it.
A couple of really important things to remember. The press, the media, our friends love to put headlines to shock and amaze people to get them to click and read articles. Fed rate hikes actually lead to lower mortgage interest rates. I'll try and remember and print a chart and pull it up for you. We haven't had a Fed hike in quite some time. They were hiking back in 2018. But in general, bonds are impacted by the future thought of inflation. Bonds so far have basically shaken off the big massive talks of inflation and all of the doom and gloom coming from that end, because they can see longer term that that's not likely to be the case. And longer term could be 2 or 3 years out. We could see another year or two of higher consumer inflation figures. But when the Fed actually moves and hikes rates, first of all, they don't directly impact interest rates. They don't directly impact much of the rate. The market for mortgage bonds are going to set that, and they're primarily focused on what happens with inflation going forwards. So the worry is that the Fed is too accommodative for too long, which is what they were last year. We were seeing signs of inflation heating up. They kept saying transitory, we're fine. The economy is doing well, and the government's pumping tons of money into the economy with 3-4 rounds of stimulus, and they are still buying mortgage-backed securities. They're still buying treasuries, and they're still leaving rates at zero. So what we're seeing right now is absolutely a normalization, and they may be overcorrecting. They may be going the other direction if they do what everyone thinks this week now they believe they're going to do. So if you look at all the experts, you look at CNBC, people are saying, well, the Fed has announced that they're going to taper and stop buying mortgage bonds and treasuries in the next 3 months. So by the end of March, we're done with that. Talking about a rate hike as soon as they finish that. Just as recently as 6 weeks ago, most people were projecting, and the last Fed announcement, the last meeting notes that were released, most Fed board members were saying probably 2023 before rate hikes. So now people are saying 2, possibly 3 rate hikes. Remember, They don't control interest rates for mortgages. The market does that. And the market is going to look at this and go, cool, the Fed finally figured it out and is doing something to put the brakes on the overheated economy here. So not a whole lot has changed from that perspective. We're looking at the longer term technicals and what's likely to happen. We said last week we thought a range for the year of probably 2.75 to 3.5 for interest rates, and we've shot up rapidly this week. You know, one of the things, Jeb, you and I looked at Monday morning when we saw sort of an irrational, no news came out Monday morning. Mortgage bonds reacted really negatively, and we're up about 1/8%. We're looking, how often does this happen? So in the last 4 years, we've seen 2 of those 4 years, the first 7 to 8 days, trading days of the year, rates have shot up. So there's a couple of reasons for that. People pull money out of bonds and go into stocks, trying to get the year off, kick their investments off. And we've seen that correct. So you are 100% correct, Jeb, that I do follow a ton of really high-end experts in this, 3 guys primarily, and the one that's most deepest in the technicals, everyone right now is basically saying, lock your interest rate. You don't want to not be locked and be floating, because in the short term, all of the technicals are very negative. When we say very negative, we're up, you know, going back, I was just looking at the chart here, from November 8th. So in the last 60 days, rates are up about 0.5%. You haven't seen that if you're watching, you know, the newspaper that reports last week's Freddie Mac primary mortgage market survey. It hasn't reflected that. You'll start seeing this later on in the week and into next week. But rates are up about 0.5% in the last 60 days, so last 2 months, and they're up about 0.25% just this week. So what we need to see is, where do we hit support? We're looking for support on that 10-year treasury somewhere between here and 1.85, and hoping it's closer to where we're at right now. So I don't know that rates are going to get a ton worse, but it's one of those things where when they start going against you, if you're in contract, if you're wanting to refinance, go ahead and get it locked and just take that stress out of the equation.
Got it. Yeah. So, I mean, again, it's short-term volatility in the market, which we saw this several times over the last year, 2 years. I mean, even last year when rates were low, we saw some volatility in the market where people thought the dynamic of the market was changing. What I would say is more, instead of, just like anything, right, guys? If you're in the housing market, whether you're, you know, in the process of buying a house, refinancing is a little bit different, but buying a house or even own a house, you don't need to look at this stuff every day, right? You know, every day the line is a bit bumpy, whereas you need to follow more of the longer term trend, whether it's, you know, a week, 2, 3 weeks out. But if you are buying a house, just make sure you're having that conversation with your lender prior to putting in offers. Hey, where are rates today, or what does my payment look like today based on interest rates versus what we spoke about originally? And that way, when you're putting in offers, you know, there's no shock, right? I mean, if you got approved at $500,000 and your interest rate was 3% and now it's 3.25%, you need to know that, right? So that it still fits in your budget, so that when you do get under contract, you're not surprised by, you know, the lender telling you that, you know, this is what your monthly payment's going to be. So just important to know that stuff, but you don't need to call your lender every day and ask what the interest rate is, or follow the bond markets, or, you know, any of these other websites out there that look at rates. It's just good to know the direction of the market. But I think longer term, I think we both agree that, you know, it's probably going to subside a bit here after we get into the new year. You know, people figure out exactly what the Fed is going to do, and you're likely to see that volatility calm down. But, you know, again, it's one of those things that you want to watch, but you don't want to overanalyze the information. Take some of the stuff at face value and just, you know, and move on. Not try to dig into to too much on it.
And a lot of what's happening, Jeb, in terms of the bond market and interest rates, is buy the rumor, sell the fact. This is still all rumors, other than the Fed confirming that they're going to be out of their purchases of mortgage-backed securities and treasuries in the next 90 days. Still don't know when they're going to raise, how many times they're going to raise, and they've talked about possibly selling off some of the holdings of mortgage-backed securities and treasuries that they acquired. So it's all rumors. So markets kind of get tense and worried over rumors, and so these moves happen, and then as more information comes out and the markets digest that. So right now we have the volatility of just the year starting off, and there's nothing special about that. There's nothing different about 2 weeks ago and today, other than traders that are on Wall Street, that they're in the Chicago Board of Trade trading bonds. They're people. They're just like us. They come in and they've got their big goals of what they're going to do this year. So you see more volatility and more movement at the first of the year. So let's give it 2, 3, 4 weeks before we start making any big brushstroke proclamations of what the year is going to look like based off of what's happening now.
No, and you actually took a quote, buy the rumor and sell the news, and made it buy the rumor and sell the facts. So news are facts now.
News used to be facts. So
it's not anymore. Yeah. So we're gonna go with news.
News. If I said buy the rumor, if I said buy the rumor, sell the news, I would just be saying buy the rumor, sell the rumor. It would just be the same thing.
Fair enough. All right, guys. So not a lot of questions in here, but we'll dive into some of this stuff. I know, you know, I'll put this one up there. You kind of addressed it, but I just want to hear you pronounce the name just so we're
Exequio Loza.
Exequio? That's pretty good. So the Fed hasn't increased the rates yet, just so we're clear on that. Nothing has happened with the Fed increasing rates. They've mentioned the idea of increasing the Fed funds rate, but that is not interest rates, guys. That is short-term rates that banks use to borrow money from one another. It is that. All right. So don't take what the Fed is doing and apply that directly to interest rates, because otherwise you're going to be misinformed with that. But do you think the housing market will slow down? I'm going to address that. And if you guys watch my channel at all, you know I talk about the housing market often just because that's what you guys like to see. And I don't know that the housing market is going to slow down, at least in the first half of the year. Now, what I mean by that is I do believe it is going to be slower than last year. I don't think you're going to see quite the craziness that we saw in the spring of last year, but I'm also a bit concerned when I say that because, you know, if you heard me at the beginning of this video, we have a third, 40% less inventory here in my local market than we did a year ago. 40% less than a year ago. That's concerning to me because, you know, you have to, you know, we saw what happened in the spring when we had, you know, 60% more inventory. We saw the craziness then. Even though home prices have increased and affordability has become an issue, there are still a lot of buyers out there on the sidelines looking to purchase property. And so, you know, something I mentioned in a video that I spoke about, I don't remember when it was because I do too many videos clearly, is demographics. And some of these demographic, you know, pieces of the puzzle, if you will. Millennials, still a huge piece of the buying pool, right? They aren't going away quite yet. You've got that. You have domestic investors. These are the pension funds. These are some of those funds that are still going to continue to buy property, looking for that fixed return, you know, on their investment, a hedge against inflation. And I also believe you're going to have some international buyers start to come back to the market, right? A lot of these people haven't been able to purchase property over the last year, 2 years because of restrictions on travel. I mean, if you take Canada, for example, Canada, a lot of those Canadians buy property in southern, you know, in like Palm Springs, in Florida, in some of these states where it's warmer. And the last year and a half, they haven't really been able to do that. In fact, they haven't been able to travel out of their state, much less start investing in real estate. So I think you're going to have some of that come back to the market as the virus starts to subside a little bit, hopefully. So I think you got a lot of pieces playing into the puzzle, and I think that's going to continue to push the market, you know, full steam ahead. Now, with that being said, what happens, you know, midsummer? I think you're going to see that traditional slowdown like you normally do. The real question is what happens in the fall of next year. This fall was really busy, one of the busiest we've had on record. I think it boils down to how much inventory do we have on the market at that time. If we still have a very low supply, I think you're going to see a strong market. If inventory has picked up, then the market will slow down a little bit. And I think that's really gonna, I think the majority of the appreciation that you're going to see in 2022 would be in the first part of the year. That's just my thoughts. Josh, you want to add anything to that?
No, that's pretty much dead on. When you were talking, I'm listening also, and I think some of the people at home may have heard, hey, listing volume is down 40%. So there's 40% less homes on the market than a year ago. But the part that I want to reiterate is Last year was an absurdly abnormally low start to the year. So it's 40% below what was already a really, really low number. Like if you look at the chart, like it's just like we're almost off the chart at the bottom in terms of listings here. And again, that's Orange County, that's local where we're at, but LA County, San Diego County, the Bay Area, not a whole lot different. Sacramento, very similar. So some of the more rural stuff, you get out in the desert, possibly, but even the populous parts of Riverside, San Bernardino are looking at the same issue. There's just not enough people selling relative to the number of folks buying.
And one thing when you said that made me think of something else, and I promise we're getting into the questions. That doesn't mean property's not coming to the market, right? I think we need to understand this. There is property coming to the market. There are homes coming on the market. The problem is demand is still exceeding that number of homes that's actually coming to the market, which is keeping supply from growing. And that is where the real problem is because until supply can continue to grow at a faster pace than people can buy those homes, you're stuck in this market that we've seen over the last 18 months or so. And this isn't a market, and I want to be clear here, that was created by COVID. COVID just accelerated the market, right? We already had low inventory coming into that market. This just added a different dynamic on top of it. And, on top of employment changes with being able to work and travel and, not having to work in the state and all this crazy stuff. That's what's pushing the market higher. So properties are coming. They're just being met with demand. And the last thing I'll say, real estate's local. You might be in an area where you're not seeing that. Pay attention to that, right? Here in Southern California, our market is one of the strongest in the nation. So what I see might not be happening if you're in middle America. But at the same time, if you're not seeing property out there, then you're probably seeing something similar. So
And sort of a follow-up on that, Jeb, obviously the real estate is local, and it's important that you are working with someone that knows your local market the way Jeb knows his local market. And it sounds obvious and simple. You're like, well, they're a realtor, they're a full-time agent. Of course they know that and they track the numbers. You would be stunned. Ask the agent that you are interviewing and wanting to work with those questions about your local market. And if they don't know them, I don't mean they have to know them dead on exact to the number for today, but they better have a really accurate and quick answer for you.
There you go. And if you need a referral to one of those, there's a link in the description below, and I'll put it up here on the screen in a little bit too. So let's dive into some questions. We got Jennifer Lego here. Jennifer is going to be one of our moderators here. If you act a fool, she is going to kick you to the curb. So listen to Jennifer. She's nice, and she does us a favor. So thank you, Jennifer, for being here. We appreciate you. Happy New Year. And she wants to make Betty White and John Madden proud. So we'll see what we can do here. Al Bundy, who is one of our regular viewers here, mentioned that his sister had a house in the $1 million range in LA, a line of buyers 4 hours waiting to see the home. Same thing on the next day. So craziness. Another thing, I just listed a lease listing in local here in Orange County, and listed it about what we thought it would go for, maybe a little bit more. In 24 hours, and I'm not exaggerating here, I've probably received at least 100 people contacting me via text, email, and phone calls for a lease. So demand on the leasing front is still absolutely crazy too. So it is not just buying and selling homes. Renting property is exactly the same way. There's a lack of supply out there with regards to rentals, and therefore demand on rentals is going through the roof, and people are getting top dollar for these properties in this market. I mean, there's a really good chance this property is going to lease for more than we originally put it out there because of that. So it's not just on the housing side that you're seeing those prices go higher.
Jeb, do you get paid for each one of those texts and calls and emails when people?
That would be really nice. Yeah. In fact, we put it on hold today because it got to the point where, I mean, I've already got applications on this thing. I mean, of solid candidates, and we're scheduled for about 30 more people to see it in the next couple of days. And so, like, how many applicants can you take on a property and actually review this stuff? So we put it on hold just because it's absolutely insane, the amount of people calling. So,
but Jeb, something you said there is helpful for everyone here, because we get a lot of times, well, I wanted to make an offer, but after 4 days they just took it off the market, or we were too late. Why wouldn't they want to keep it open and get more offers? There's just a certain point, there's diminishing returns. It takes time and effort to review each one of those offers and see the qualifications, the strength, what the net's going to be, the things they're asking for, vet the other agent on the other side. So at a certain point, you just cut it off and make the best choice and move forward.
yeah, no, absolutely. I mean, yeah, well said. I mean, we could dive into that deeper, but I think that's enough. Let's see here. Dom's Vibranium Bicep. Happy 2002, fellas. How much do I have to worry with the market for a drop in equity in Tampa if I don't plan to move for 5 to 10 years? I think you're probably pretty good. I mean, Florida is one of those markets that's going to continue to be desirable because of the weather, minus the humidity, the bugs, all that good stuff. But it's a solid place to live. I mean, housing is still, there's still demand on the housing. That Tampa is densely populated, so you're lacking areas to build in Tampa. You're having to go on the outskirts and build outside of these areas. So I think as a whole, probably a desirable market. Hard to say what's going to happen in 5 to 10 years, but I think that is the idea, right? Holding real estate longer term gets you past any bumps in the road that do happen if something does happen in the future. But I think you're probably pretty solid. I mean, I would have very few issues with buying something at the moment if my time horizon were 5 to 10 years out. Hi y'all says bunch of houses for sale in San Jacinto. So yeah, depending on your market, more might have a little bit more inventory. Now San Jacinto is one of those areas on the outskirts here of Orange County. Is that San Bernardino or is that Riverside? I don't even know.
It's Riverside County, but it's out there.
I mean, it's going to be, I think Riverside today had 2,200 active listings on the market. So there's going to be, I'm doing a video talking about Southern California on Friday that's going to come out where I'm talking about some of this stuff. But Riverside, San Bernardino is still going to be popular areas this year because people are going to get priced out of Orange County. People are going to still continue to move to some of these surrounding counties, if you will, and which is going to keep things moving, forward. But a bunch of houses for sale compared to what, right? Compared to last year when we had none, or 3 months ago when there were a few. So it's all relative. So keep that in mind when you're thinking about property on the market. Michael Dury, Michael's here, also a regular viewer as well as Maddie. So thank you guys for being here. Cindy Juggle Goddess. I know it's not your market, but in the San Francisco Bay Area, how many weeks or months should I allow to remodel a dated kitchen and 2 bathrooms before selling? It's going to vary by property. It's going to vary by contractor. I mean, I can give you an example here. Some friends of mine in my community bought a house some time ago, a couple months back, and did a full remodel. Literally gutted the entire property. The only thing standing was the property itself. In the same community, there was one about half the size that started a remodel. I don't know, 6-8 months prior to them. They just finished their remodel before the smaller one did. So it depends on issues you potentially run into with the city, your contract. There's a lot of factors that play in there, but I would think a full kitchen and bathroom remodel, you could get it done in 4 to 6 weeks. I mean, I would think is more than reasonable, depending on how long it takes to get the material. Josh, you could talk a little bit about that and flipping property and timeframes on some of this stuff.
1,000%. It's a more complex question than it sounds. It sounds like a fairly simple question. The big thing is material lead times. You guys know I just did a house out in Orange. We finished up about 6 weeks ago, and many items that we wanted either had to be swapped out for something other than what exactly we wanted, or we had to wait to get them. So with the kitchen, your big deal is cabinets. If you want to have them built, a lot of the cabinet builders are super backed up as people have been home and wanting to do their kitchens. So that could be months. If you order them, it could be months to get them ordered. Even if you use the ready to assemble cabinets that you can get off the shelf, they may not have the ones that you want available. So it just depends on the type of renovation you're doing. The important thing, just get with a good contractor, find out what their timelines are, check their references, ask a couple people they've recently closed completed projects for and confirm what their timelines look like, and then give yourself a nice buffer of another 25, 30% of what they quote you for how long it's going to take.
There you go. Good stuff. Victor, how am I doing? I'm doing great, Victor. I appreciate you asking. You're the first person all day to ask me how I'm doing. I appreciate that. Now, thanks for being here. Ashley Tung just put in an FHA offer on a property in South Florida yesterday. Inventory is low, very aggressive. Yeah, and that's the market I think you're going to see for a period of time. Just as we mentioned earlier, I'm not going to even try to go with that one.
She said, Korean, just call me BNLA.
Yeah, just the Korean name there. B and LA. There you go. First time home buyer, boyfriend and I made an offer yesterday, $30K more than the asking price of $499. And guess what? Seller agent told us there was a cash offer way above our number. It's just crazy. Yes, it is. It is. And we could dive into this sort of thing, but here's what I'll tell you. Just because you're going up against cash offers, don't get discouraged. You can still win property having a loan. A lot of it has to do with your agent, your lender, making the right phone calls to that agent on the other side. And you're not going to win every one of them. Cash is desirable, especially in a market where things are selling above the asking price. Values start to become an issue in some of these areas. Cash is king in that regard. But if the people aren't in a hurry, there's a chance that they may want to give a family an opportunity to own property in this environment. I've heard stories out there. In fact, people have been commenting on my videos saying, hey, listen, I'm a seller. We had multiple offers. We decided to actually sell our property for less money, to the investor, or instead of selling to the investor with more money, we chose to sell it to a couple or a single individual because, we wanted to help out. So there are people out there that are still willing to work with you. So don't get discouraged in that regard. Here's a question for you, Josh. Do you know if a 40-year interest-only rental property loan for investors, is there one? What is your opinion on that? So let's just start the question. Are there 40-year loans at all at the moment where you as a consumer can start a new mortgage with 40 years?
Any loan longer than 30 years doesn't meet the Fed's qualified mortgage definition. So what that means is they are riskier for a lender to make. They can't be sold off in the same way. So the lenders that make them are wanting a premium. So by definition, as soon as you go to a 40-year, you're paying a premium interest rate. Nearly everyone I've seen, the premium in the interest rate that you're paying more than offsets the benefit of stretching out to 40 years. So do they exist? Yes. Do I know of anyone closing one in the last 5 years? Either myself or any other loan officer that I talk to, I don't know of anyone actually utilizing the product.
Good stuff. Victor Pham, I wanted to ask for your advice. I want to sell my home in Garden Grove, but I just got approved to build a 1,200 square foot ADU. Should I sell now or after I build the ADU? Is it better to rent? So the second half of the question is something you have to figure out with regards, is it better to rent it? I mean, if you can afford to keep the property and rent it out, in my opinion, always the better choice, especially having the option of having the ADU there too. You got potentially two different rentals, right? I mean, in theory, that's a duplex of sorts and can bring in a decent amount of income and long-term gain on the property with regards to appreciation and all that stuff. And you got to do what's right for you. So that's a whole separate question. But answering the first part of the question, should you sell now or build the ADU? You need to figure out what you think the value of the property is at the moment, what it's going to cost you to build that ADU, because just because, building costs at the moment are at an all-time high. Lumber's expensive, materials expensive, finding a good contractor is difficult to do. Timelines are pushed out. So what's the cost on your money for one? Like, how long is it going to take you to build this ADU? What's it going to cost to build it? How long is your money going to be tied up into that? And then try to work backwards and figure out what that ADU adds to the value of that property. Just because you spent $500 a square foot, to build that thing you're going to probably get close to that on the ADU, but doesn't mean you're going to get this huge return on that building that property out. You've got to find the right buyer that wants an ADU for one. And also, there's a lot of moving pieces there. It's not black and white. Sometimes it's very hard to comp these properties out because there's nothing out there like it. And so you're putting something on the market that it may not be, no one around you has something similar. So it's hard to gauge what the true value of that property is. I don't know. Josh, what are your thoughts on this sort of thing? I mean, I think you got to weigh it both ways. It's not simple black and white,
It was
math, if you will.
it was simpler before the pandemic and drove material and labor prices up, because you probably could build it at a price where you could guarantee it was going to add more value to the home, to the property, than it was going to cost you to build it. But I agree with Jeb. I mean, it's always tempting when there's money on the table. But like we always say, is sell and do what? Okay, so ring the cash register and move to another property, rent it out and buy another property with less down, and then control two assets. So you have a lot of moving parts, and you have to know, like Jeb said, your cost on your funds, how much funds you have available. Is it realistic to do both? If you keep this one, is it going to limit what you're able to buy just in terms of purchasing power to a lesser home than you would want? But in general, we've talked about this ad nauseum on the show. The bull market in real estate is not up, and the longer you can control more assets, the better off you'll be. I mean, at some point we may sit and say it's going to turn around, but one of the best investors I know held everything through the last downturn intentionally, and he knew it was coming. No one knew how bad it was going to be, but he said, I buy all of my properties for a reason, and as long as they keep fulfilling their purpose for me, that I'm renting them out and it's putting money in my pocket and I'm using that money for the purposes that I wanted to, I'm not going to sell the properties. I also know other investors that sold when they sort of saw the downturn coming in 2006, 2007, sold everything. But just a long way of saying, know your goals, know your objectives. The answer in terms of, is it better to build an ADU and then sell? Jeb gave a great answer on that, but my theory would be, if you can swing it financially from the numbers perspective, build the ADU, keep it and rent it, even if that means doing a cash out refi and then moving on to a slightly less expensive home. You're controlling more assets and building greater wealth over the long haul.
Yeah, and at the end of the day, if you decide not to build the ADU, what's keeping you from buying the next property and building the ADU on that property? I mean, if that's the plan, right? It sounds like this property is either going to get sold or turned into an investment, which means you need to, I'm assuming, buy something else unless you're going to rent. And if you do buy something else, maybe there's an opportunity to take that money and add value to that property to give you, more appreciation or what have you. So again, a lot of moving parts, but talk to your agent and have that conversation and see if they can direct you in the right way. And if you don't have one, reach out. It's a conversation we can have. So SMAC or SMAC or SMAC. I don't know. SMAC's what we're going with. What do you think about the Arizona market? So my thoughts are, if a market did well in 2021, chances are it's going to do well in 2020. That's just my thoughts. Now, here's what I will say. I'm going to look up something here while we're having a conversation, because I have a friend that sends me information on Arizona about once a month, and he's in the Phoenix area. And what he sent me was this came January 1st. So 2022 starts with lower supply than 2021 did. And we all know what happened in 2021. January 1st, 2021, there were 6,055 listings. So they're down 5%. And let's see here. The total blah, 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 basically goes on to say, not a good start from a buyer's point of view. The lowest supply level for January 1st since we started recording in 2001. So with that said, now I realize there's a lot of missing pieces to that, and I can send you this report if you don't get it. But inventory's low, right? And at the moment, rates seem to stay like they're going to stay low. Demand looks like it's still going to be there. So I think you're probably going to have a market that continues to move. Now, there are parts of Arizona that probably aren't having the craziness that Scottsdale, Phoenix, that Phoenix metro area is. Maybe some, on the in the outskirts, but I know cities like Flagstaff and some of these others are still booming. So I think you're probably going to see something similar for some time. Let's see. Freddie, any advice on using spare cash to build an ADU on a property for renting purposes versus looking for a second home and house hack? living in it and rent out rooms in North San Diego. So we kind of address this a little bit.
So, Jeb,
Yeah.
before you jump into it, let's give a little backstory. This is our friend Freddie Luna, longtime viewer, regular viewer, bought just a little more than a year ago in San Diego. In about middle of last year, he popped up on the show and asked us, "Hey, do you think I can refinance an FHA purchase? Do you think I can refinance and get into a conventional loan with no mortgage insurance?" We're like, well, it's a little aggressive. San Diego's been hot, but possibly. So we checked it out. We did the appraisal. It actually went up more than 20% in the 7 or 8 months that he owns it. So he's in a good position. Bought the house, already refinanced, got a much lower payment. He's got some spare cash. So now, with that as a background for Freddie, Jeb, what are your thoughts on him building the ADU or buying another house?
Again, it kind of relates to the question we asked with Victor. You got to figure out what's right. Do you want to have an ADU in your backyard? Are you going to rent that out? Are you okay with a tenant living on the property with you? There's a lot of things that go in there, and it sounds really simple, but it might not be. So I think there's some things that you need to figure out, right? I mean, if you bought a second home, or you got to look at it. What's it going to cost you to build that ADU? How much can you rent it for? How much does it add to your value? 3 things to think about there. Also, if you buy an investment property, how much is that going to cost you? How much can you rent it for? How much are you positive cash flow there? So there's a couple things that I think you need to do some calculations on and figure out what the costs are, what the benefits are, and see if they're doable, right? I mean, the problem with building in the environment that we're in right now is that things are so expensive to do, even for small like ADUs. I mean, it's these contractors, good contractors, are booked out weeks, months in advance and don't want to take on small jobs. And so, these smaller jobs, and when I say an ADU, I'm talking, a thousand, maybe 1,200 square feet. These are smaller jobs. While they seem like they're relatively simple and easy to do, there's still time and materials and all of that goes into it. So I think you got to weigh it out. Again, not really that simple of an answer. I know you have an agent, or you did at least when you bought that property. So maybe run some of that by them, get them to do some analysis and see what pencils out best for you. And figure out if that's the right way to go. I mean, and then, buying rental property in California is tough to do because a lot of it doesn't cash flow unless you have a big amount down. So that's the other side of it is buying a second property. How does that look on paper? Maybe you can buy something out of state, less money down, that actually cash flows without having to put a large chunk down.
Well, one of the things that he's looking at here is that whole house hack idea. Again, millennials kind of changing the market, doing things their own way. If you live in it, you take the master, rent out 2 or 3 other rooms. The rooms rent for more in aggregate than if you rented out the whole house. So even in San Diego, where cash flow on a lower down payment can be an issue, it can work. So if you can control an asset similar to the home that you own and live in one of the rooms, rent a few others out. Again, if you're younger and you have a few young people that are in your peer group that you're comfortable living with, it can be a really good way to control an asset with a manageable monthly payment. And in other parts of the country, Jeb, just put this in context. This is nuts. I was talking to my sister a couple days ago. About 2 years ago, they're in North Carolina, Fayetteville. They bought a second home, like $135,000, and put my niece in it and said, "Hey, you can live here free, but you're going to rent the rest of the rooms out." She rents the rest of the rooms enough to pay the rent and give my sister back another $500. So it's just nuts. Certain areas, the rent versus home prices is a little different and out of whack. It may be the same in Kinston, where this house hacking is the way to get rich.
Kinston. Oh boy, here we go. I'm going to address this one real quick because it's an easy one to address. So Brittany says, what's the first step when looking for a home? Do you get pre-approved first? And the answer is absolutely. You want to make sure you're working with an expert, not a call center, not calling the person that you saw online or whatever. Talk to an expert. And pre-approved, let's explain the difference. Pre-qualified, maybe you're having a conversation over the phone. You're just telling Josh, hey, I make, $100,000 a year. My credit score is this. This is how much money I have in the bank. These are my debts. And Josh says, yeah, based on all that, you can qualify for X amount. Pre-approved means he's running my credit, looking at my debts at report on my credit report. I'm filling out a loan application, and he's analyzing that information along with my tax returns, along with my W-2s. and telling me exactly what I can afford by going through the information. That is the process that you want to complete prior to looking for homes, because otherwise it could set you up for, a big heartache when you go out and look at property, find out that you can't qualify. And secondly, you really need to know what does it match your budget, right? Some people think, well, you know, I can pay $5,000 a month, and then they realize that part of their income isn't reported or whatever, and that they can only qualify for much less. So you just need to have that conversation, document it, and make sure that you are, at where you should be with regards to uh, being pre-approved prior to starting that. And then, if you do talk to an agent first, the agent's probably going to refer you to somebody to have that conversation. If they don't, you need to find a new agent, right? Most agents out there, and I realize this is bothersome to some people that they, hey, I make great income, I have great credit, I know I'm going to qualify. Well, if you call me and you haven't been pre-approved, I'm going to tell you need to talk to a lender. And if you don't, I'm not going to waste my time showing property. And that sucks for the person out there that's the buyer. But the reality is I got to make sure that you're doing what you should be doing so that neither of us are wasting our time. So that's my 2 cents on that. And I said it would be a really quick response, and I kind of drug it out.
It's not though. It's a simple one, Jeb, but there's a bunch of questions there. So I moderate on a channel that helps veterans with their home loan financing. And probably the most common question we get on there is a version of this. Hey, I want to buy my first home. What does that mean? Where do I start? What do I do? So at least we know what the first step is. It is getting the pre-approval, and that can be in conjunction with the realtor. So let's say you come to me, you watch this video, you go, hey, Josh is super smart, I want to talk to him.
Nobody's going to say that.
No one's going to say that. I'm going to go through this and say, awesome, are you working with a realtor? Because we want to loop them into this conversation. They're not, a third party out there that doesn't need to know this stuff. And they don't need to know the details of your finances. They need to know what you are approved to qualify for, what we can do in terms of contingency timelines. So it really is. It's a three-legged stool there. You are the most important as the borrower, but having a good lender that gets you good and accurate pre-approval numbers and then hands that off to the realtor that then can translate that into homes in your market that you want to live in and would like. So Jeb, along those lines, we are here at New Year's resolution time. Did you want to talk at all about the plan we're putting together? We do a little webinar here at the first of the year.
Yeah, we're behind on our plan, in fact. So I'm not sure we should talk about it quite yet. Unless you just
it'll force the two of us to get it done. Throw the date out. Tell them when we're going to do a webinar.
Wow, we don't have a date. Here's the deal. By next week, we are going to have a date. We're going to do a live first-time home buyer course where it's going to be live in this regard, but we're going to talk specifically about certain pieces of the home buying process. And then from there, we're going to take, I think, questions. We haven't really this is really throwing things out there because we haven't really figured out exactly what we're going to do, but it's going to be an invite only type thing. We're going to really drag you through the home buying process so that when you come out of this, you know exactly what you need to do and the steps to take, and set yourself up for success, if you will. So, Josh, what are we going to do? Would you like to add to that? But before we get into that, and I'm going to take this off the screen, there's a link in that little scroll across the bottom that will link you to a real estate agent or a lender anywhere in the country, an expert, someone that I know on the real estate mortgage side that can guide you through the process, professional, not a call center, people that know what they're doing. So, and I had somebody reach out to me the other day and ask about Puerto Rico, and I completely dropped the ball and didn't get back to him. So that just reminded me.
I have a lender in Puerto Rico, and apparently the reason why he moved to Puerto Rico is there are no good lenders in Puerto Rico. Like even if you go wherever the bank,
I need his info.
It's like 90 to 120 days, best case. And most of the homes, was interesting to me. People just list their own listing, like on Craigslist, and people will call on it. So the realtor is not as esteemed in Puerto Rico as in other parts of the United States.
Yes. So send me that. That reminded me of that. But Josh, what are we going to do with this course exactly?
We're going to give you A to Z. What do you need to do in what steps, and what does it actually mean? A lot of things. So Jeb just went through and kind of gave you a brief overview of what a pre-approval is and how it varies from a pre-qualification. But all of those things, all of the jargon and terminology that we may use, that even Jeb and I might throw out here willy-nilly with that, with just thinking that we deal with it every day and you know what that means, we're going to give you all of the information and knowledge you want and need to make accurate, secure decisions about entering the housing market. You know, it's not the same as 2013, 2014, where you could afford to make a little bit of a mistake, overpay for a property, get a bad loan because homes were so cheap at that time. We've seen a lot of appreciation. Still a good idea for most people if they're at the right stage of their life to jump in, but we want to go through and arm you with all the facts and knowledge that you need to make good decisions.
There you go. And we're also going to explain what willy-nilly means, just
Willy-nilly.
in case you were concerned or didn't
It's
know what it
Gabe's,
meant.
it's Gabe's dad.
Smart Soccer. Hey guys, if we refinance our primary and want to keep it as a rental, how long before we can move into a new primary with a conventional loan? We'll have at least 30% to put down. Thanks, Megan. So Megan is Smart Soccer, in case you were wondering. She just gave up her alias. So how long after refinancing your primary can you buy a rental or buy a new property and turn that one into a rental?
There is no hard and fast rule. When you take out your loan, you are putting on the application that you intend to own or occupy as your primary residence. You're signing an occupancy affidavit that says within 60 days of closing, you are going to occupy as your primary residence. What you are not making is a promise to live in there for any specific period of time. What will happen if you go back, 15 years ago, a borrower could go into 5 different lenders, apply for 5 loans, and buy 5 different properties owner occupied, and lenders had no way of knowing. And what happened is the mortgage industry got together, created something called the Mortgage Electronic Registration System, MERS for short. So every loan gets registered there, even at the application stage. So people, a lender knows what you've done with other lenders, and they know what you stated that you intended to own or occupy. Now, again, in your situation, if you go to own or occupy another property, buy another property, owner occupied 30 days or 90 days later, putting 30% down, well qualified with a good reason why you intended to live in the other property when you took out that refinance, you're not going to have a problem. We have 3 of these that we've done in the last 12 months within 45 to say 120 days of closing a previous owner occupied transaction. All of those, you have to package them very well. You have to explain to the new lender why it's reasonable that you're going to owner occupy and why you couldn't have foreseen that when you did the last loan. But get with a good lender, talk to them about it. If it's packaged well, you shouldn't have a problem, as early as 90 to 180 days after closing your current refinance.
Got it. So good explanation there, Josh. So a couple of these questions are going to throw up are talking city specific. We got Danier asking about Oklahoma, Jagadish, maybe asking about Miami. Unfortunately, guys, being here in Southern California, don't have a lot of insight on some of these other markets. But what I can tell you is that, a lot of these major markets like South Florida are going to continue to be strong just because they're desirable locations. A lot of them have experienced what we've experienced here in Southern California, and that's big, a huge buyer demand, lack of supply. So those markets are going to continue to move. Areas like Oklahoma is a little tougher for me, right? I don't know that area quite as well. I do know South Florida. I was there for some period of time, so I understand the market. I got it. What killed South Florida last time was the overbuilding of these high-rise condos. And I think a lot of that has slowed. But even then, you got to look at supply and demand, right? If supply is increasing, continuing to increase, that is going to slow the housing market. If you're seeing property move very, very quickly, days on the market staying low, regardless of where you are, that's an indicator that the market's going to continue to stay strong. So for the time being, I would say that these markets are probably going to be pretty strong, but talk to an agent in those locations, talk to an agent in that market and, get an idea of what they're saying. Professionals. And if you need a professional, I just threw a link up there a little bit ago. There's one in the description below. I know people in both of these markets that I can refer you to that know what they're talking about. So that's where I'll leave that. And then there was another one here a little bit further down where someone was talking about, where was it? Austin. So ATX Flips is saying, looking to sell in the Austin area. Do we target first week of February or later in the spring to maximize profitability? Hard for me to say, right? I don't know the market well enough in Austin, right? I can tell you what it does here in Southern California, but there are areas where weather changes the dynamics of when property should go on the market and when things start moving, all of that. What I can say is I have an awesome agent in Austin. He just closed a referral of a buddy of mine that I referred out there recently. And rock solid. My client was a buyer, or he's a buddy too, but he was a buyer and got it done. So if you need a good agent in Austin, I got that for you. But that would be the person to talk to. Josh, any new strategies for low down payment for a conventional loan for 2022? So where are we currently with?
So yeah, if you're at a standard balance loan, so not in a high balance area like Orange and LA County where we can go up to almost $1 million, you can do 3% down. If you're a first time buyer, it's a little bit better of a program. If you're not a first time buyer, it's a little bit, you can be required to have a few other things. So long way of saying you can do 3% down if you're on a standard balance loan. If you go to high balance, you're looking at 5%, and nothing has changed for 2022. And I don't expect it to. Anytime that it's proposed of coming up with different lower down or even a zero down option, really big pushback. People freak out and think, oh, this is why things went wrong in 2006, 2007. When the reality is the size of the down payment is much less predictive of risk of default as are other factors, but it just has a bad stigma to it. So I wouldn't expect ever getting it to less than 3% or 5% if you're in a high balance area.
All right, guys, complete side note here. Received a voicemail while I was on the phone, started reading it. So I just thought it'd be interesting to throw it out there. I've got someone contacting me. They're new to Huntington Beach. They're a videographer. They want to know if I want to create a real estate TV show or video content online to help promote my business in Huntington Beach and Orange County. Wow. Should we call them? Say, yeah, we want to go on YouTube.
How would I go about creating video content?
How do we do this? Anyway, side note. Good stuff. Let's go. There was a question up here that I wanted or a comment. Eddie just says, San Bernardino County, he corrected himself. Inventory is a joke. Want to sell and upgrade, but nothing good on the market yet. I've been contacted by 2 people in San Bernardino towards the last half of last year, December-ish, that I know, are going to sell property in that market. So I would imagine you're going to have more and more inventory, right? We're the first week of the year. People are just getting out, over the holidays, trying to figure out how they accomplish their New Year's resolutions in the first week of the year and not break them. Give it a couple of weeks and you're going to see more property come to the market. That's my 2 cents or my thoughts on that.
Jeb, we actually had a good comment here. This was in response to another. We have someone here in the feed that believes that interest rates are going to be 6% next year.
Yeah, I didn't really think that was worth even commenting on.
But it's not. But this gentleman, Serge, commented the Fed won't meaningfully raise interest rates because they can't at $30 trillion debt. So I think he's been listening to us before because we've talked about this. Again, the Fed doesn't directly control interest rates other than the prime rate. Other than what they did during the pandemic, they bought treasuries, so they created additional demand while the supply was exploding and was able to help keep yields down. But we've talked about this. When Obama took office, $7 trillion federal debt. By the time 2 years from now, when Biden leaves office, he's going to be over $30 trillion. The country's going to be over $30 trillion debt. We have a 4x in the national debt. If you had a 6% mortgage rate, it means you have treasuries at somewhere around 4.5, which is 3 times what they are with 4 times the national debt. So if you want to do a little quick math, it's about 12 times the debt service for the national debt relative to where we were in 2008. It's not going to happen. If something can't happen, it can't be true, it won't be. So Serge was dead on with what he said there.
There you go. Here's a good question. XX, hope you guys are doing great. Can you explain how cash out refinances work for investors buying cash, remodeling, and renting after, kind of like the Burr method? How does the 75% loan to value work and how long does it take? He goes to say, some say 1 month, some say 6 months. And then also, what type of loan is that considered? So if you're buying a property, you're paying cash for it, you want to pull some of that cash out, maybe to buy something else or just get your money back. What's the process of that, Josh? Is 75% loan to value where you need to be? Conventional
70,
loan, all that good stuff.
yeah. So 75 will get you better terms, but you can go all the way to 80. You'll pay a little bit of a premium for it, but anywhere at any loan to value up to 80%, you're good with doing that. And you can do it at any point once your construction is complete. So the BRRRR method is buy, remodel, refinance, and rent. So the refinance has to come after the remodel if there's any health and safety issues. And if you're doing paint and carpet, we can start the refinance right away. Now, what you're saying here is it 1 month? Is it 6 months? The biggest issue that we have is investors using this method are trying to buy at a discount. Well, you can't use the appraised value for a cash out refinance for 12 months. So you have that waiting period there that we have to get through. But once you get through that, it's like any other refinance that you're going to be able to complete it in 3 to 4 weeks, no problem.
All right, there you go. Let's see. Joe Santoro, what is the lowest down payment method to purchase a first rental property? Now, I think you just mentioned it, 20% down. Is that where we are with investment, or we can do less, but going to get crushed on the rate?
Single family, so 1 unit you can do 15%, but yeah, you're going to pay a pretty hefty rate and pretty hefty mortgage insurance on that.
Got it. And that would be a conventional loan, right?
Yes.
All right. Carrie, unfortunately, don't really have thoughts on the Colorado market other than what I said about, markets that did well last year, I think will do well this year. A lot of these second home type markets too, which Colorado has some of these cities that people want second homes, I think will continue to do well. Supply demand. It's really that simple. I don't know it well enough to give you much insight other than that. So Mr. Sellers Homes, North Jersey real estate, heard rates hit a 3.49 base rate today. So Josh, let's talk about rates for a minute. Not in the context of answering that question per se, but you might hear somebody talk about a 3.49 base rate, right? Completely irrelevant unless you know what that is based on, how much money those people had to put down, how much, are they buying? Are they refinancing? What type of property? Is it a single family? Is it a condo? Is it attached? What's my credit score? All of these things matter when getting an interest rate, right? You can't just take one interest rate that someone quotes and say that is the new base rate, right? Simple, right? And if we're comparing rates, we've got to be able to compare the exact same scenario within a short period of time. So if you're buying a house or you're refinancing and you're getting multiple quotes, you need to have conversations with lenders pretty quickly, right? To get comparable numbers. Doesn't mean you can't do one today, one tomorrow, one the following day, but if you do that, it's not comparable. The market moves daily, hourly, minutely. Either way, things move very quickly and change all the time. So you can't compare these things without having some sort of basis for that comparison. But where are we low side of interest rates today, Josh? Just
so I haven't
perfect buyer.
Yeah, I haven't locked anything in the last couple of days, so I just had to go run it. So standard balance, Fannie Mae conforming loan amount, you're looking at 3.25, right at par for your best qualified borrower. You start having a 680 credit score, it's going to be higher. You have a lower down payment, it's going to be higher. So that's 25% down, 780 credit score. You can still get 3.25. And again, a week ago that was 2.99 or 3%, and a month ago that was 2.75. So definitely up, but are these things to be concerned or worried about? Prior to the pandemic, that's the greatest rate in the history of the U.S. mortgage market. So you got to keep things in context. Yes, prices are higher, so every little bit counts, but interest rates are still amazing even after the run-up that we've seen here.
All right. This is the part of the show where I ask a favor. If you're watching, we're an hour in. We're going to do another hour here. 314 of you would like to ask if you find any value in this content at all. Hit the thumbs up, maybe share it with somebody that is considering buying a home. The goal here is to help inform people, not to get you to buy or sell a house, inform you so that you have the information to make informed decisions on your side, right? We just want to arm you with enough information so that you feel better about the decisions you're making. And maybe answer the questions that your lender or your real estate agent can't for whatever reason. So hit that thumbs up. It does help. YouTube promotes it when that sort of thing happens. So that's why we ask it.
Along those lines, Mr. Jeb, on this question for XX, I think I misspoke and said 12 months. It's 6 months. So it's 6 months to use the appraised value. So depending on how long your rehab takes, it's probably going to be buy, rehab, rent it out, and then we're going to refinance once you hit that 6-month time frame.
Got it. You know, it's so funny when you said 12 months, I almost questioned it, but I was like, nah, we're good. And so I should have now. So you could have looked at your thing again. Let's see what we got here. So Victor has a follow-up question. Should I delay the building of my ADU and build paycheck to paycheck, or should I cash out refinance? If I don't qualify for enough, should I get a personal loan? Personal loan, I would say absolutely not. Just my personal opinion. Cash out refinance is going to be the best opportunity to take cash out at a reasonable interest rate, to get that money out. I wouldn't build it paycheck by paycheck. I would only build it once you had the funds to build it. And even then you need to be able to take, that whatever that number you're being quoted and add probably 20% to it, just in case of overages, just in case of time delays, whatever. Based on what you're telling me here, I would tell you, you don't need to build an ADU, right? I mean, if we went back to your first question and you had the money on hand, I would say that's a different scenario. If you're in the position now where you're considering selling that property and or thinking of waiting to build the ADU to do it, that to me seems like that's so far out in the future that it might not even be a piece of the puzzle that you should be considering at the moment. The question now is, how much can you sell your home for at the moment? And what is your plan once you sell that property? And is that a realistic plan based on that information? That's what you should be considering, more so in my opinion. Now, the other option is, can you keep that property as a rental and buy something else? If that's the case, does it pencil out on paper? Does it cash flow? If it doesn't, can you afford the overages or the amount that it is upside down? There's a lot of moving pieces there, but I don't think the ADU, based on what I'm hearing here, should even be thrown into the equation yet. So just my 2 cents in how I would handle it. Robert Corona, every day, first time viewer, just subscribe. Good day. Not every day. Good day to you, sir.
Good. I said good
first
day,
time viewer,
sir.
Just subscribe to the channel, here to expand my knowledge, enjoying your content and explanations. So appreciate you being here. You're what makes the channel continue to grow and why we do this sort of thing. So thank you. Let's see. George, will 2023 be the year things correct themselves? Honestly, hard to say. I mean, I'm not willing to go out and say 2023 is going to be like 2022 or 2021. What I will say is I don't think it's going to crash. I mean, based on where we are at the moment, right? But I don't know. It's hard to predict what's going to happen in 2022. The factors that are pushing the market at the moment are the same factors that we've had for the last couple of years. So the question to ask yourself, or to ask in general, is what is going to change the market to change those factors? That's what we have to think about. What is going to change that is going to create a change in the housing market? First, it has to change demand. It has to change demand, which then slows demand enough for inventory to continue growing. But even then, inventory only grows if people decide to sell their properties. If people have low interest rates, they're looking out there and they can't find something to replace their property, those properties don't come in the market. So we've got that part of the problem now. There's just so many moving pieces, but nothing happens until demand diminishes enough for inventory to grow to a level where things slow. And at the moment, we're not there, and I don't think we're going to be there for some time. Now, interest rates are the one thing that could do that, but nobody knows. It's a guessing game as to when that really is going to happen. There's theories out there that rates can go up. There's theories out there that rates really can't go up. And so, at the end of the day, it's guess what this year is? It's midterm elections, people, right? I'm not political in any sense of the word, but I can tell you, people are vying for votes. There is going to be an opportunity here, for both sides to try to position themselves for a new election, and nobody's going to shake up too much. Just my thoughts. So, and that's something we really haven't talked about at all, but that's going to play a part in how people deal with certain things in the market, in my opinion.
So Jeb, we got
Yep.
we got to get our work done. Brittany says, I need that course. Can't wait.
Oh boy.
B in LA followed up with that would be amazing.
You speak Korean, bro?
She told me she
No, I
converted
feel
it
like
for me.
I felt like you just read that and it was Korean.
Yeah.
You know, somebody made a comment earlier that, you know, California crime is going to push people out of the state. Yeah, it may, like, right. So we have some crazy things here in the state that allows criminals out after a certain period of time and some other craziness. Yeah, there will be people that move because of it. Just like there's people that move because of taxes, people that move because of politics, people that move for whatever reason. But understand the net migration in California is minimal. As many people move out, there's almost as many people that move into the state. And even then, there's so many people that live here that even if people did move out, there's still people here that are home buyers and want to stay here. So, you know, those migration patterns that you see aren't going to change. California is its own, it's like the 5th largest economy in the world. California, something I saw. I don't know if did you say that earlier or did I read that earlier?
You read it. I saw one that's even crazier. Orange County is bigger than like several big countries. The Orange County economy, that blew my mind.
Yeah, so California, I think as a whole, is something I read, the 5th largest economy in the world. So people moving in and out, very little change with regards to housing, especially in the short term, in my opinion. But we had Andy go on to say that I feel like the neighborhood crime doesn't affect home selling as much as it used to. And I would say, you know, depending on where you are, that's true, right? People do. I mean, when I have families purchase homes, they're usually a little more concerned with crime and schools and that sort of thing. So people do still consider these things when buying a property. It's a conversation we have, but you know, where I sell property, fortunately, it's not really an issue in most of these areas. So it's not something we really have to deal with very much. Let's see. I did see a good question here, Josh, and I forgot where
While you're looking for it, we got a comment here, and I'm going to be mad at you. It says, Digital Cash Cow, who's actually Rob, says, hey, Jeb, it's Rob. I changed my name. Sent you the LIBOR letter. Can't refinance. They say undeveloped property. So you'll have to share the LIBOR letter with me.
I thought you were on the email.
It's possible. We were out of town.
All right. I'll make a note.
Long way of saying,
Josh.
Rob just had a question a week or two ago about what happens because LIBOR is getting retired and what they'll have to do to his interest rate to actually, or his index to actually get him an interest rate. Another one here, Jeb. Artur Vardanian says, in Austin, houses being sold 50 to 100 over asking price in a couple of days. Should I wait for the market to cool down or buy it with those crazy offers?
You know, again, me talking about the Austin market would be like me talking about, you know, China and telling you what you should do with real estate there. It is a completely different market than where I am. It's too hard for me as a real estate professional expert in Southern California to tell you what you should do in Austin. Find a local pro there. I have a great one. In fact, I mentioned earlier, I just referred a buddy there who bought a property in that market. He did a 1031 tax exchange. So he actually sold his property here in California, bought 2 properties, actually bought one in Austin and one in South Texas. I don't remember the city off the top of my head, but it closed escrow today. So if you're looking in Austin, reach out to me. I have a great agent and can refer you. Let's see what we got here. I can't remember.
This is actually an interesting question, Jeb. While you're looking,
I was actually just going to click on it. Yep.
So you want to go with
it? Yeah, I use Trulia to see listings and homes go pending really quickly. Are these properties available on the MLS way sooner, which gives those working with an agent an advantage at viewing and offering? No. What happens here is, so we put a property on the MLS. When we do that, it syndicates to all these sites. So what that means is it goes like viral, if you will, to sites like Trulia, Redfin, Zillow, Realtor.com, all of these sites, right? And then it populates on their websites. what happens is, depending on when you see it, right? Some of these properties move very quickly. So within a couple of days, it could be a pending property. Other days, sometimes, some of these websites don't update their information quite as quickly, right? I know sites like Redfin and Zillow, usually within a couple of minutes of changing something on the MLS, it's changed to these sites. Trulia, I would think, would be in the same bucket, because I think they're owned by Zillow or one of those guys. So it should update quickly, but no, I mean, working with an agent per se doesn't necessarily give you an advantage. What I would say is, working with an agent, what I do is I set you up on another feed that comes directly from the MLS versus one of these other sites. It's okay to still use those sites, but if it's coming from the feed itself, you're more likely to get accurate information with regards to it being an active listing, a coming soon, a pending, or what have you. And so, it just better information, if you will. So, find a good agent, have them set you up on something, and then they can guide you in the right direction. I did see a question about Redfin. That's what I was looking for, and that triggered my thoughts on Redfin that I wanted to go back to. I didn't want them to think I was skipping that question. Oh, here we go. So Dennis asked, what do you think about selling with Redfin to save with seller cost? It's definitely a strategy out there. I would tell you that I honestly think if you put me and a Redfin agent side by side to compete for the listing, I would win, even though they're probably doing it for less commission. And it's because the value I bring to the table as an agent, as an expert, not only in helping you price your property accordingly, but also helping you negotiate on the other side, right? When part of Redfin's strategy is that they'll list the home for less money, and essentially you're going to net less money. But chances are, I don't want to say what I'm really thinking here, but most of the professionals out there aren't willing to work for less than they think they're worth. Okay. So an experienced agent selling property usually wouldn't sell out for less commission to get more inventory. I wouldn't personally. I'd rather sell less properties, do a really good job for my clients, take care of my clients, versus having a boatload of property and just, being, tons of calls and trying to work through property to make the same amount of money, right? My goal with my business is to develop relationships in the business, and handhold, if you will, and help people get through the process and understand the process. And that's what a professional brings to the table. So yeah, you're always going to find somebody out there that'll do it for less money. I mean, hell, there's people on the radio here offering, some absurd amount that they'll list your home. Great. But what I can tell you is, every day I'm getting calls from people wanting to sell property, willing to pay more to do it. So it's just like any other thing. You can always pay more money and likely have a better experience, better service. And in this case, probably net more money, because you have somebody that knows what they're doing, helping take you through that process. But interview both, interview 2, 3, and feel, and see where you feel the value lies. I mean, the value isn't in what a lot of people out there promote. We're going to put your property online. Redfin's big thing is we have a big following, a big, app, and all these people follow. Great. That property's on every website. You can't say, I'm going to put your property online. Everybody does that. Well, like, what value is that? You can put your property online. The value comes in what happens after that offer is accepted. What happens in when you start negotiating that property? What happens when you receive multiple offers? How do you strategize? How do you counter people? How do you deal with requests for repairs? That's where the experience comes in. That's what you pay for. But sorry, guys, I'll step down now.
Well, here we can take a nice break from that, because Josh is clearly having a New Year's hangover. Derek follows up that 75 LTV is the maximum for investor cash out refinancing, not 80, and he is 100% correct. So Mr. XX got 2 wrong answers, but thankfully,
this is great. Next week, I'm going to have a new mortgage broker out here.
Yeah,
this is
exactly.
Great.
So 6 months, you can use your appraised value. 75% is your max on non-owner. So on an investment property using the BRRRR method, owner occupied, you can go to 80.
All right. Well, there you go. We're gonna scroll
We
down
had, we had a
here.
fun comment here. So Liz in Puerto Rico said, you should hire a real estate attorney. I'm the buyer. Seller is working with. I think there's a question there. Should I hire a real estate attorney? I'm the buyer. The seller is working with the realtor agent. I'll be financing through a bank. What he said about the lenders here in Puerto Rico is 100% true. Please help. So Liz, what I would say, reach out to Jeb and we'll put you into contact with my guy in Puerto Rico. He's a broker. Those terms don't sound bad at all. I mean, you had actually mentioned what terms they were offering you, 3.5% on a 17% down with only an $89,000 purchase price. It's a relatively small loan. Those can be more expensive, but we can put you in contact with my guy out there, and he can direct you on what you should do on the real estate side.
All right. Let's see here. So Carrie says, would you recommend doing an extended lock on an investment property loan to lock in a low 4% rate? So I think Carrie probably need to know what an extended lock is. Are we talking extending it because you haven't haven't closed on the property yet? I'm assuming that's what we're talking about here. You haven't closed on it, so you need to extend the lock 90, 120 days. Is that what we're talking? Or are you close to closing and you need to extend it because you're not closing on time? So Josh, maybe you can understand the.
Yeah, I think she's asking a longer term. He or she is asking. They are asking, should I do a long term lock? We've seen rates spike up 0.5% in the last month. If we knew for a fact it was going to do that, it would be nice to have a time machine to go back. But realistically, if you're talking 120, 150, 180-day lock, that's about the premium that you're paying. So if you can get 4% locked on an investment property for that longer term time frame and you're not having to pay up front for it, it comes down to your level of risk tolerance. If I were in the market right now, I follow the market very closely. I would be comfortable not doing an extended lock. But as a regular consumer who doesn't follow and research and know what I know, unless you're pretty open to taking on a level of risk, I wouldn't argue against it. But I would also want to know if there's an upfront cost and ask them, what would it be for a 30-day lock today versus my 90, 120-day lock, and then make your decision based off of there. You're basically buying insurance that rates could continue to go higher, which I don't not expect them to do, but I don't expect them to go appreciably higher in the next few months.
And Liz Puerto Rico came up with her we didn't do this, right?
Yeah, we did.
Okay, sorry. I know you saw the top part. I didn't know if you went down there. I was doing something on another screen, so my apologies. NorCal Trucker, first time home buyer here, looking to buy this summer. Any advice? Buy used or new construction, Sacramento area. So advice is get pre-approved. Get pre-approved sooner rather than later, even if you're looking in the summer. And the reason I say that is to make sure you're good, right? Sometimes there's things that show up on your credit. Sometimes the way your income's documented that change the process in ways that you could correct it if you knew now versus waiting until then, right? So I think even if you're 6 months out, get it done and know where you stand. It's not going to cost you anything to do it. It's not really going to affect your credit score. One hit on your credit to figure out where you are is not going to be a big deal. So sooner rather than later. Second part of the question, new construction versus buying used. That's to each his own type question. Typically speaking, where I am here in Southern California, most of your new construction, is not as centrally located as existing construction because there's a lack of land. And any big project being built is usually being built further out away from central Orange County, if you will, just because that's where the land is. And so you've got to be okay with that. I want to be closer to the beach. I want to be in a certain area. So for me, buying used makes more sense. But here, the new construction is so expensive. The lots are smaller. The homes are stacked 3 levels in some of these cases because they're trying to maximize the land. So for me, the new construction doesn't really fit the bill here in Southern California where you are. You've got to kind of weigh the pros and cons. I've actually done a video on it where I talk about pros and cons of new versus used. And there's some things in there to keep in mind. Buying new construction can be way more expensive because of all the things you have to do to bring that property, to make it like an existing home. A lot of yards aren't finished. A lot of the stuff when buying new construction are added fees that cost money, which, depending on where your budget is, may or may not make sense. So you can check out that video. If you want to reach out to me directly, I'm happy to put that in front of you with a link. But there's a lot going on there, but I would say get pre-approved sooner rather than later. I think that's the best thing you can do.
An interesting question in its timing here. Tiffany Boyce says, are interest rates higher for second homes? Well, yesterday they were not. Today they are. The FHFA.
Not yet. April.
When are they doing it? Is it April? Okay,
April.
So you have till April. The FHFA announced this morning that they're going to be pushing that out to Fannie and Freddie. Depending on your loan to value, it's going to be at least 0.25% higher interest rate, possibly a little bit more, depending on how much you're putting down on your second home.
Yeah. So, I mean, at the moment you're good, but it is eventually going to go up based on what the FHFA put out. I'm trying to find something, guys. So hold on.
Sal has one here. It says,
right.
Can you avoid the 20% down on an investment home if I choose to live in it for a year, then leasing it? 100% correct, because it's not an investment home. You're buying a primary residence. Primary residence rules would apply. And then after 12 months, you're obviously free to lease it and move on to another property.
All right. Okay, here we go. So digital cash cow, how does the landlord go about paying his rent when the economy shuts down? If it were to shut down, how does the government have programs? I want to put mine to rent, but scared rentals will park there. So prior to COVID, there was no programs out there. If the economy shut down, which I don't know that it ever had in that capacity, you would be responsible for the rent. In this case, you were still responsible for making that mortgage payment during that time. But they did come out and there were forbearance programs and other things put in place to allow renters and landlords to miss payments for a period of time, which, has been 18 months or so in the making from when that ended. But traditionally speaking, there's nothing in place that protects you if a renter doesn't make their payment. So that's why being an investor, you got to know that risk. You got to be willing to take that on, have some assets in the bank in case somebody doesn't make a payment. You're in a position to take on that payment, so that your credit doesn't get messed up and you end up in a position, in a bad position. So I would say, don't expect the government to help you, right? That is part of the problem, I think, moving forward with what we just came out of, is because the government intervened so much. If anything happens like this in the future, people are going to expect that to happen again. And I hope, for many reasons, that neither of those happen again. But that's a whole different conversation. So we won't get into that.
So actually, Rob, the digital cash cow, is a very smart man. He said, these guys are very informative and provide us with insights. And then he followed up with, hit the like button, guys.
There you go. 137 likes, guys. We're doing pretty good here. We're doing pretty good for the new year. We got people telling us about appreciation in the markets. These guys are very informative. Yes, I see that. I am trying to find some good questions for you people. We did have one here asking about a good time to buy, but I would tell you, kind of go back and watch the beginning of the show, Life with Elo. Just got in. Is this a good year to buy a property? We've talked about it. What I'll say is that I think the market is going to continue to move higher price-wise. Maybe not as crazy as last year, but expect that things are going to move quickly. Homes that are fairly priced, that in areas where supply is still low, demand is likely to be high, the homes are still going to appreciate. Doesn't mean they're going to appreciate it 19, 20% like some of the craziness we saw last year, but you are likely to see homes more expensive 6 months from now, potentially 12 months from now, because of where the direction of the market. But again, real estate's local, so make sure you know where you're buying.
So, by Jeb, George Picato also said lots of nice things about us. So I don't know what the first part of his question is. The way she explained the math made it doable, but he follows up with that, said, how do you pick a good realtor?
Ooh, that's a good one. He went up here. I saw the first part of his question. So he said, made the worst mistake, went with a realtor in 2020 and gave her a budget of 330. I was about to sign a contract on a $380,000 home. The home is nice, but like that's crazy. And then he goes, you know, now he's asking, how do you pick a good realtor? So I don't know where that question is if you want to hit it again. First off, you want to find somebody that's been in the business, somebody that has experience, somebody that just got their license. Everybody's got to start somewhere. But find somebody that has experience, have a conversation with them and fill them out and figure out if you feel like they're a good fit. You want somebody that knows the market that you're looking to purchase in. Somebody that has strengths in negotiating, can understand, market dynamics with regards to supply, demand, appreciation. And you say, well, what does appreciation have to do with it? Well, sometimes in order to get an idea of where a home's going to sell, you've got to look back and see what the market's doing to be able to factor some of this stuff in to realize how you should make an offer, how you should present an offer, when it's a good idea to remove some contingencies, if at all. And also you need somebody that can have a conversation with an agent on the other side to convey how well qualified you are, somebody that has good resources, good contacts in the business. Real estate is a lot like any other businesses out there. A lot of it has to do with who you know in some regards. So if you have insights into agents that know other agents, that's a good thing, especially in a market with low supply. A lot of times you can hear about things that are coming on the market prior to them coming on the market. Sometimes if your agent works in an office with a lot of heavy hitters, they're aware of things that other agents might not be aware of. That's important in this environment because that could be the difference in you getting into a property and not getting into a property. In fact, I can name at least 3 times last year where I'm pretty sure the only reason my offers got accepted is because I knew the agent on the other side. And they knew how I did business and were willing to work with my client for that reason. So that's important. And I've talked about it in other videos. You can search it on my channel. I don't know if it's Picking a Realtor or one of those, but I've talked about all the things you should look at. So you can go search it there as well. And NorCal Trucker, one more question. How does new construction loans work? First time home buyer. So Josh, new construction, I'm buying a property. How does that loan work? Do I have to use the builder? Can I use my own lender? What's the process?
Yeah, they're going to require you to get pre-approved with their lender, and people sort of bristle at that. There's some shitty parts to it, but for the most part, think of it from the builder's perspective. Time is money, so as soon as they finish that property, they want to have it sold and off their books. Certificate of occupancy comes out, they want to close a day or two after that. So they don't necessarily need you to close with their lender. They need someone they trust and have vetted to assure them that it can be done, so that if your lender falls on their face, you can actually close and get the loan. They will oftentimes give you incentives to use their lender, design center credits, things of that sort. But for the most part, their lender is going to be a little bit more expensive. They offset it by giving you some stuff to try and get you to use them. But you can use any lender that you want. It's like anything else. You're going to be forced to shop in this instance, or you're not forced to. You can just go with the builder's lender, but there's your one pre-approval. Check with at least one other lender and compare them, compare and contrast, and see who's getting a better deal for you.
Good stuff. We got some good questions here for you, Josh, on the mortgage side. If you're on a parental leave of absence, but have a return to work date, can you still pre-qualify? So the question is here, maybe not really employed, but I'm employed. Can I use my income? Like, how does that work with a lender?
So as long as we can verify that you are going to go back to work and you are going to be back on the job prior to the first payment date on the loan, which again, so let's say we close here, we close today, January 5th. We don't make a payment February, it's March 1. As long as you are back to work and earning money prior to that, we can use your income. If it's going to be longer than that before you go back to work, if we have reserves that can get you through that time, you can use that. So it's just important to work with someone that knows the guidelines and that you give them the information you've given us. When are you going to go back to work? Maybe order that verification of employment up front so we have it in hand stating off on parental leave, scheduled to go back this date. But it's manageable. Just communicate with your lender and let them know where you're at, where you're going to be, and what you're trying to accomplish.
There you go. And what happens in that situation, Josh, where I'm on a leave of some sort and I have no income during that period of time? How are you going to qualify me for income purposes, right? If I have a gap of that income because I'm on some sort of leave and maybe I wasn't paid during that period of time.
It only becomes a problem if you have someone who has a large amount of commission. If you make $80,000 a year salary and you're on family medical leave and so you're out for 2 months, so what? You're going to go back and you're going to make $80,000.
Got it.
So if you have variable income, it can cloud that a little bit, but for fixed income, hourly rate, annual salary, it's not going to make a difference.
There we go. Here's another good one too. I want to get to Savoy. Does Airbnb income count the same way as long-term lease income? So let's talk a minute and talk about how we get income, how we use income for qualification purposes, Josh, and then we can kind of address the question.
So for rental income, we have to analyze the Schedule E from your tax return. So as long as you've had that property and it's been on your tax return and we can see the rental income you've received, it counts as any other rental income. And usually it's much higher levels of income than what it would get. As an example, I have a client who has a property in Florida and it's a vacation rental. And you look at it, it's like a $600,000 house. It brings in $100,000 a year in rent. You're like, how in the world does that happen? Well, it's because it's a vacation rental. But because we have that on the tax return, we can use that amount. Now, what happens when you buy a property as a rental, you put it on Airbnb, so you don't have, and it hasn't hit a tax return yet. If your rental income doesn't show on a tax return because you recently purchased the property, we can use 75% of the rents. In that instance, you're in a gray area, in a difficult spot with an Airbnb or vacation rental, short-term rental, because you don't have a long-term lease. So we don't know, are you going to rent it 1 week the rest of the year? You're going to rent it wall to wall for the rest of the year. So that's where it can be problematic. But once you've had it for a few years and you have the rental history on it, you're fine.
All right, good stuff.
Jeb, let me jump way back up top here because
Yep.
one of your normal viewers, aka regular viewers here, Broderick Smith, had a question. It says, "Hey, love y'all live." Now remember, it also, when you say nice things about us, it also makes it more likely you get your question read. I had Lexington Law working on my credit. They removed one item off my credit on trans, and my Equifax went down. What's going on? So, one item being fixed doesn't mean that nothing else changed in there. And again, some things, with something being removed, that's generally a positive, a negative item being removed. Now, on the flip side, if it was a collection account and you pay it off, like that can be worse in the short run, and that's paradoxical. But what I would say in this instance here, any number of other things could have happened. You could have had a charge hit a credit card and the balance was higher on that. The other thing is there's a lot of moving parts here. If we're working on getting that credit score up, it can take a while and you got to let the process work out. That being said, Lexington Law doesn't have the best reputation in terms of this stuff. They like to send out the letters to the creditors challenging items and trying to get them removed. Oftentimes they get removed and need to get added back in. If you'd like a second opinion on it, we have a reputable credit repair company that we work with. Just reach out to Jeb and we can get you in contact.
There you go. Good stuff. We got one here. What are your thoughts of rental properties in higher crime cities? Is it worth the risk? So real estate's all about location. Regardless of where you are in the country, real estate comes down to location. Homes in desirable locations will always appreciate more, bring in higher values for rental income, just be more desirable when people go to purchase them. So I would say, is it worth the risk? Not to me. I wouldn't risk it. But it depends on what you mean by crime, right? I mean, is it is it like is it Compton in the 80s, or is it, Compton now, right? Compton now is nothing like it was in the 80s. So now I buy in Compton for sure. But what I have 20 years ago, probably not, or 40 years ago, I guess at this point, whatever it is. So to each his own. It's one of those things that you got to be okay with. But I would say, it's got to make sense, just like any other rental property. In that area, does what you can bring in rent wise outweigh what you might lose in appreciation because of the lack of growth in that area for whatever reason? So just some things to keep in mind, but also pay attention to what's happening around those areas. Like downtown Long Beach for a long time wasn't really a desirable area. Over the last 10 years or so, they've really, developed that entire downtown scene, which is taken values way up. So if there's a chance that something like that happens in those markets, those are things that maybe you factor in, but it's a bit of a guessing game.
And I would just say, this is personal opinion on this. Unless you have strong feelings that there's a change in the neighborhood going on that would lead to lower crime rates and better in the future, I would just avoid it. It's not worth it. Not only can you have problems with tenants having problems, having a lower class of tenant that's willing and able to live in that area. I have a property in a very blue collar area, but they're good working class people. And it's a safe neighborhood for them to live in at a lower rental rate. I wouldn't want to go into a high crime area where the people that are living there are people that have to live there because that's all they can afford. On top of that, you can get property damage, vandals, any number of crimes committed against you and your property. There's plenty of good properties elsewhere. For me, I would rather invest out of state in a safe area than locally in an unsafe area.
There you go. Agreed. Josh Reniel, we are thinking of refinancing our first mortgage with 3.2 rate and our HELOC, which is at 4.9. Can we blend them together? And what rate are we getting, higher or lower? So it's hard I'll say, he can't tell you what you're going to get because he doesn't know your loan amount, your credit score, all of that stuff. So if you're in California, you want to reach out to Josh, I'll put a link on the description later. You can reach out to me. I'll connect you. But Josh, just doing that math off the top of your head, 3.2, 4.9, what rate would need to make sense in this environment? I guess without knowing the loan amounts, it's hard to say.
So the key thing is to get an accurate blended rate calculation. So as an example, if you had a $400,000 first and a $25,000 second, the blended rate's going to be really close to that 3.2%. We have another viewer of the show that we were talking to a couple of weeks back. He has a $250,000 first mortgage and a $250,000 second mortgage at similar rates. He had a really good rate on the first. It was like 2.5%. But when you blend in the 5% from the second, they were roughly equal size. It made sense to do the refinance. So you really just have to sit down with someone and do the numbers, tell them what the loan size is, and then we got to go through all the details of everything that Jeb was talking about. We can get you an accurate quote, but this is a simple case where numbers never lie. We plug them into a spreadsheet, get you the blended rate, show you what you can get currently, and it'll be obvious whether it makes sense or not.
And I'm going to put this up here, not a question, but I want to just make a point here. So Tiffany says, going to do a cash out refinance on my home because it's gone up 150,000, but I have a 2.25 interest rate. I don't want to refi at 3% interest rate. People, interest rates right now are super low. That's another reason you're going to see a lack of inventory, a lack of people making that transition, moving, is because people have really low rates, right? They're looking, like Josh just said, prices are sticky to the upside. If somebody purchases a property for 500,000 and values go down to say 450, a lot of those people aren't going to sell until values go back up. Interest rates are another one of those things where people get this super low rate, this super low payment. Home values have gone up, and now they're thinking about buying something else, and they're looking, going, wow, rates are percent higher than where I bought last year. So not only has the price of that value, that property gone up, they're also paying more money for that monthly payment because of rates. So that is going to be another factor that continues to limit supply just because of how cheap money has been for a period of time. And so I think that's something to keep in mind out there, and another factor that's likely to continue to keep, inventory off the market. Let's see. We got a couple people asking. There's I mean, good neighborhoods in Orange County, there's a lot of them. Too tough to answer this question on here. I would take up too much time. Reach out to me directly. I'm happy to have that conversation with you, guide you in the right direction. Sam is asking about foreclosures in LA. Yeah, there's some, I'm assuming, coming to the market. It's competitive out there. Anything that is, any opportunities out there are getting bid up just because there's a lot of investors sitting on the sidelines looking for opportunities. So I wouldn't be thinking you're going to get a deal, but there are opportunities out there. You just gotta, you gotta find them. Excuse me. So, Josh, anything you want to add? Any of this stuff? Any questions you're seeing?
No, it's supply and demand. There's a tiny supply of foreclosures and a huge demand for homes. So regardless of whether it's a foreclosure, short sale, inherited probate property, it's going to sell for market value, and the market will dictate that, not the fact that it's a distressed sale. We have one here, Jeb, that she's actually popped up a couple times. I think ask it a couple times, but let's get to it. How much house can I get with 80,000 in student loans with a 30-year 30K a year income with a high credit score? The income is going to be the bigger issue here. So $30,000 a year is $2,500 a month. So max with any loan program is going to be about a $1,250 house payment. Might get you close to 200,000. And one of our listeners here, our viewers, practitioner, a regular viewer, says, answers correctly and says, likely depends on your monthly payments used to calculate debt to income ratio. And she followed up with, it's $56. So she's on an income-based repayment, $80,000 of student loans, only $56 of student loans in the monthly payment.
Oh,
if there's no other debt there at all in that situation,
you got
that 1250 comes down to 56. So it's going to be under $200,000. So depending on where you are, it may be possible. If you're in Southern California, it's going to be almost impossible. So hopefully you're in a lower cost area where you can get into something.
There you go. I'm just reading through some questions here. This is, BookTube got us another regular viewer here asking about potentially backing out of a property because, the property needs flooring and kitchen and all of that stuff. Should you back out? Unfortunately, we can't answer these questions for you, right? You've got to decide on whether or not it makes sense to you. How much is that property worth in your neighborhood that you're buying with the kitchen and the flooring and all of that stuff, added into it? Are you paying market value for that property, similar to what other properties that are completely redone? Are you paying a similar price for those properties? Then maybe something to consider. But if you're actually getting it for less than maybe some of these other properties have sold for that have been redone, there's an opportunity for you to add some value there. So it's too much going on to just give you an answer. But trust your agent. And that sounds silly, right? Because a lot of people out there say, well, your agent just wants to sell you a house. They don't really care about you, whatever. I've told many people in my career not to buy a house. In fact, I have people send me property weekly, clients that I'm working with asking me questions about property. And many times I'm telling them, let's move on to the next one. Let's move on to to something else, because of another factor. So if you have an agent out there that truly cares, knows what they're doing, you're going to get an honest answer. So hopefully you have one of those and you can rely on them to get it to you.
Jeb, this is the part where I remind you I've got a 7 o'clock appointment, so I'm going to leave you to 15 final minutes here of question answer.
Adios, bro.
All right, kids.
All right. Josh is out. I will throw Josh's contact information up here on the screen in a bit. So if you were looking, I'll know if Josh was important if I see the number of people watching right now just drop considerably. Let's see what we got. So we'll go another 5 or so minutes here. Mr. Kyle from Win the House You Love is here. He made it, but he's late. So Kyle, thank you for joining us. Hey, another YouTuber out there that does a lot of informative videos on the housing market. Search his channel. You'll find it. Not a doom and gloomer, really just provides, data information you can use if you're buying a house. So really, really good stuff. So check him out on that front. Let's see. So this is, Tiffany's been a popular choice tonight with picking for comments, but she says, I'm being stalked by people and real estate agents leaving notes on my door and in my mailbox wanting to buy my home. Is that common? I even get postcards with pictures of my house from Google Earth. It is extremely common in an environment with low inventory. It's always been a marketing gimmick for a lot of agents out there, right? There are agents that farm neighborhoods, that are agents that do certain types of things to try to drum up business. And one of those is door knocking. One of those is sending letters to your house saying that they have a buyer. There are different forms of trying to get listings, if you will. Now, oftentimes the agents contacting you, writing you letters, whatever, don't even have a buyer. They're just trying to have that conversation with you to see if you're a realistic seller so they can potentially get a listing. In other cases, in the environment we're in at the moment, there are a lot of people out there looking for property. In fact, I had someone call me today looking for a property in a specific neighborhood. In fact, my neighborhood, and they want a specific type of property. So that could be a letter I send out to that community, to specific types, that type of property, to try to drum up a listing for those buyers. So it's not uncommon. It's even more common in the environment we're in right now because, having property to sell is king. Working with buyers is tough. It's tough to get offers accepted. It's a lot more work in this market just because of that. So having those listings are good opportunities. So you're going to continue to get people to reach out to try to drum up that business. So it's completely normal for people to be doing that. Let's see. Mr. Win the House She Loves in here, coming in hot tonight. So I will throw emails up here at the end. My email's in the description below. I don't want to bombard you with all that stuff. I do know a good agent in Savannah, so reach out to me if you need that. I'm not going to put that up here. COVID with longer-term trend that will continue. So Power Realty Advisor says, hey guys, I keep reading about crazy rent inflation numbers. Is it just the rental market bouncing back from COVID or a longer term trend that will continue? I personally believe rising rents is going to be a thing that is going to continue. Maybe not at the rate we've seen, but the rental market, as I mentioned earlier, is very much in demand. There's a lack of available rentals out there. Things are renting very quickly. In many cases, renting again for higher than the number that's advertised. I mentioned earlier, I just put a rental on the a lease on the market yesterday. I've had at least 100 people contact me via email, text, and phone over the last 24 hours. I finally had to shut it down because it just got too crazy. But we have a ton of appointments. We had multiple applications before anybody's even seen it. And so it's that thing. That's the market that we're in. So I think these numbers are real. I mean, I did a video a couple days ago where I showed the rise in rents, and rents are up, I think, about 15% or so across the board in most markets. Now, I don't think it's going to continue like that, but I think you're going to see properties continue to rent, right? I mean, there's a lot of investors out there buying property, looking for a fixed return every single month on their investment. So they're buying rental property, investment property. You have Black Knight, all of these big conglomerates, if you will, that are, pension funds that are putting money into real estate, which is driving up, prices of rentals because of trying to get that fixed return every single month. So I think it's going to continue. I don't think it's temporary for the time being. So just my 2 cents on that. Kiki, honestly, don't know the answer here. Is it easier to get a modular home than a regular home? Honestly, I don't know it depends on the market that you're in. If you're talking modular, some people think manufactured, so are we talking about the same thing? If we're talking modular, I'm not super familiar with it. But if you need somebody to reach out, I'm happy to put you in touch with someone there. I'm trying to find some good questions. People, hang tight. So Wesley's asking, is it allowed to get an FHA loan on an old house, then tear it down to build a new one? So you can get an FHA loan on a house, and if you have the money to remodel it or what have you, you can do that. But if you want to, use that same FHA loan for the cost of the construction and that sort of thing, then you might need a construction loan on that side. But there's also an FHA 203K that allows you to buy a property that needs work and allows you to factor those repairs, those costs to remodel that property into your original financed amount. So it's called an FHA 203K. They're a specialized loan. They take, your value that you're buying it at now versus what the rehab value is after the fact, and they allow you to use a certain percentage of that to do those repairs. So it's not as easy as I just made it sound. It can be a complicated process. So you 100% need to make sure you're working with a professional that understands and knows how to do those, because otherwise it could be a nightmare. It could end up costing you the deal in many ways. So just keep that in mind. But a 203K, I think, is probably more so what you're looking for. Digital Cash Cow coming in with another good question. Does changing employers affect your opportunity with a mortgage loan? Same sector, industry, oil and gas. I feel like I need to make a move on the loan approval first before moving to another career. Can it affect your potential possibility to qualify? It can, but chances are, because you're staying in the same industry, same line of work, you're probably going to be good. As long as employment is steady, income is, consistent or increasing, you're going to be in a good position to do that. But if you are thinking of that career change and you've been pre-approved, just have that conversation with your lender. They should be able to kind of direct you in that regard and tell you, things to potentially not do or what have you when going through the process. And if you're going to get significantly more money with that career change, maybe you wait to get pre-approved until after that happens so that you can qualify for potentially more property. So that could be an opportunity on that front as well. I'm getting a lot of, is it a good idea to do these things? It's really, really difficult to answer. So Mike says, Dad wants to sell me their house here in Florida, possibly just under market value. Should I do it? Just like buying any other property, you got to make sure it's the right time of your life. If you can buy a property truly under market value in this environment, I think absolutely. As long as you're comfortable with the payments, still a good idea to have some money in the bank. Even though it is a family member, your father in this case. So hopefully, all is on the up and up there. But I would say anytime you can get a property under market value, assuming it's a property that you want to live in a location you want to live in, it's something that worth considering. Absolutely. I'm just looking here. Let's see. Amazing days. Can I use an FHA loan to buy a second home property? Thank you. The answer is no. FHA loans are only for primary residences. So you can only use it for a home that you are going to occupy as your primary home. So not allowed on second home or investment properties. Got a lot of questions going on here, people. You guys are throwing them at in hard. Let's see. I just bought a home in August. How long till I can apply for a second home loan for $70,000? There's not really a limit on that. If you're getting a home equity line of credit and you have the equity, you should be able to do it pretty much immediately. There shouldn't be any restraints on time frame when doing that. So you should be able to make it happen pretty quickly. How we doing out there, people? I'm looking for some questions here for us. And I realize that people in here getting irritated because their questions aren't getting answered. If you saw how many questions are here at the moment and one of me, you'd understand why questions don't get answered. And if you continue to post them, I don't answer them anyway, just because it just makes it even more difficult to get through this stuff. Let's see. Keith says, how fungible is the primary residence rule where you have to live in it for 1 year? Heard people could buy another primary sooner for reasons like they have a new kid, etc. Yeah, that's exactly it. It's got to make sense, right? When you buy a property as a primary residence, you're essentially signing that occupancy affidavit that says you're going to occupy the property within 60 days. It doesn't say you're going to occupy it for a year. It doesn't say you're going to occupy it for any specific period of time as your primary, but the intent has to be there to live in it as your primary. So if you decide in 6 months, hey, listen, oh, wow, we found out wife's pregnant, we're going to have a baby, we need a larger house, that makes sense. You're probably not going to have any issues buying another property, but it needs to make sense on paper to an underwriter so that, they can make the decision. But typically growing families, moving for jobs, things like that are viable reasons for someone to want to purchase another primary home. So just keep that. And it's also got to make sense, right? If you own $1 million home and you're going to buy a $400,000 home in the same city, that's not going to make sense, right? It's got to make sense on paper for someone to understand that. And that's regardless of whether or not you've been in there for a year or not. It's financially, or on paper, it's got to make sense to the underwriter why you would be buying another one as a primary. All right, guys, we're pushing on 2 hours here at the moment. I'm going to answer a couple more questions and then out. Let's see, I'm looking for some good ones, something that can help everybody. So Teresa asked, what are thoughts about taking out a 401k to loan to use as a down payment for a home? In some cases, it can make sense. You've got to figure out if it's the right situation for you. You're essentially borrowing money from yourself. So not a bad way. I mean, I do think if you're in a position where that's your only option, it's going to be difficult to save money faster than the market's going to appreciate. So I think if you can get into a property now, even if that takes pulling some money out of a 401k to do it, it may make sense. But that's a question honestly, for a tax advisor, for a CPA, somebody that deals with that side of it, just to make sure you're not going to have any issues there with the amount that you take out. Sometimes there's a limit on how much you can actually take out to purchase a home. So you just want to make sure that you're set there so there's no issues on that front. So just do your homework before going and wanting to pull money out of a 401k, just to make sure you're not going to have any repercussions by doing that. Wow, you guys are coming in strong. Ray says, Kyle without Javier, how is that possible? Oh man, throwing some your way there, Kyle. What's up, buddy? All right, guys, we're gonna wrap this up. We got a lot of questions here. What we're gonna do is every Wednesday I do a live. It's 2 hours long, right? So I know a lot of you are like, Jeb, why don't you answer my question? I've been here for 2 hours. I got a family at home. I'm gonna run, but I will be back next Wednesday where we do this for 2 hours from 5 to 7 o'clock, live at 5 every Wednesday. So join us. If you have a question here, bring it up. I will answer it. I will continue to answer some of these questions after hours in the thread so that you can see them. But if you're still watching and you haven't done so already, I would like to kindly ask that you hit the thumbs up, show us some love here, show us some support, taking the time to do this. We did 48 lives last year, 96 hours of content, free of charge to help you guys become better buyers, better sellers in this market. So thank you for doing that. And then also I'll throw up one other thing. A lot of you guys ask me about getting in touch with lenders, with agents. There's a link right there. If you go to that, type in your information. I have it set up where it automatically connects you. Took some time to get it done, but it did. And it is super resourceful. And I've had a lot of you guys reach out and thank me for it. So there's a link. Check it out. If you need a good realtor, you need a good agent, happy to refer you. But I do appreciate you guys a lot. Thank you guys for being here. That link is in the description below. Again, if you need it, if I took it off prematurely. But thank you again for the support. Thank you for the love. I will be back next week. Have a good night, my friends. Adios.